So if I was to start investing in stocks all over again as a beginner, these are 5 most important things that I will consider before buying my first share. Buying stocks can really feel very confusing when you are a beginner, but you have to think about this way. When you want to buy your first stock, you're actually becoming part owner of that company. So as an owner, you want to make a smart decision, or you need to make smart decisions. So today I'm going to break down the 5 most important things you should always check before buying your first share on the stock market. I'll keep it very simple and clear so you get to understand if you are absolute beginner. Make sure to stay to the end of this video so you don't miss out anything. First thing you need to consider is to understand the business. This is very, very important because if you don't understand how the company makes money, you won't know whether, it has a bright future or not. Let me give you an example. You see, MTN Ghana, right? Before you invest in a company like this, you have to know how does MTN make their money. It's mainly through calls, data, and their mobile money service, right? So when people buy data or transfer through mobile money and make some calls, MTN makes a lot of profit, right? So the more calls, the more data, the more mobile money transfers they are making, MTN keeps on making profit. So compare this to a company that sells a very complex product that you can't even understand. If you can't explain to a friend how a company earns their money in one sentence, you probably shouldn't invest in that. So Warren Buffett once said, never invest in a business that you can't understand. And it is true. So always start with what you know. That's a good sign that you can follow its progress. The second point is to check the company's financial health. Imagine you are about to partner with a friend in a business, right? Wouldn't you want to know if your friend is already making some money or is already in a deep debt? You have to look into their books if they are making money or they are running into debt. It's the same thing about stocks. Here are the main things you have to check when you want to invest in a stock. Number 1 is the revenue sales. You have to check if the company is actually selling more each year or their sales are dropping. So you have to consider the previous sales to the current sales, whether it's going up or it's dropping down. The second point is also to check the company's profits. Is the company making profits after their expenses or are they losing money? The next thing is debts. Does the company owe too much? Is the company drowning in debt? If the company is drowning in debt, it means that it might collapse during tough times. So you also check the cash flow. Is the company generating some real cash or they are just showing off some numbers on paper? So let's say you are looking to invest in GCB Bank. If their reports show increasing customer deposits, higher loans given out, and steady profit every year, that is a good sign, right? But if the bank is losing customers day in and day out and has loans that are not even being repaid, that is actually a red flag. You don't need to be a financial expert to check this. Many companies' websites publish their annual report, so you have to make sure you check their reports on their websites and even have a quick glance at revenue and profit trends. That can tell you a lot of things about the company before you invest. The third thing you need to consider is the price valuation. You see, here is a big one. The price really matters. Even if you find a great company like GCB, MTN, and the rest, if you pay too much for it, your returns might be very poor. Let's go outside Ghanaian stock market and look into a US stock market. Let's say you love Coca-Cola, right? Everyone drinks Coca-Cola and the company is a very strong company. It's been around for a long time, but if the stock price is way too high, compared to its earnings, it means that you might be paying more than what it's worth. That's like you're paying 100 cedis for a bottle of Coke. It doesn't really make sense, right? So this is where something called price to earning ratio comes in. If a stock has a price to earning ratio of 10, that means investors are willing to pay 10 cedi for every 1 cedi of the profits the company makes. If another stock has a point to earning ratio of 30, that means that investors are paying like 30 cedis for the same profit. A high PE isn't always bad, right? Sometimes it means that people expect or investors expect the company to grow faster. But if the company is not growing, then it means the stock is overpriced. So let me give you an example. If MTN is trading at a PE of 7, right, and a competitor in Ghana is trading at 20, that means that MTN might be a cheaper option, but you must check if MTN's growth matches that. You always have to compare prices to the value you are actually getting. So the fourth thing you have to consider when investing in stocks is dividends. Dividends are like a company saying thank you for being their shareholder. I mean, when you hold shares and when a company makes profits, they share some of the profits with you as a shareholder. You being part of the company, you also receive some percentage of the profit that they've made, depending on the number of shares that you have. So this is like receiving a rent from a property that you own. But in this case, it is rather from stocks. So why are dividends so much important when you want to invest in stocks? I mean, dividends actually give you cash flow even if the stock price doesn't really move well, right? Companies that pay consistent dividends are often considered to be stable and profitable. So let's take Apple as an example. Apple is known for paying dividends regularly. So if you own Apple shares, you are likely to get paid consistently. On the other hand, a company like Tesla doesn't pay dividends at all. Tesla reinvests the profit back into the business to grow it, right? I mean, both approaches can work for you. It just depends on what you actually want. So if you like passive income, dividend stocks might be attractive for you. If you also prefer growth, you want your share price to grow, then you might also focus on companies that do reinvest back into the business. And the last thing you need to consider is to think long-term and manage your risk. That is the most important mindset you have. You have to think long-term when you want to invest in stocks. Stocks are not get-rich-quick schemes that you make money, you put in money today and tomorrow you make money. Prices will always go up and down daily. If you panic every time the market dips, it means you're going to lose your money. But if you focus on the long term, you're going to see a solid company which grows over time and you also make a lot of money from it. Think about this. If you bought MTN shares 5 years ago, you would have received not only dividend, but also price appreciation because the price in the past 5 years has grown significantly from 0.75 to 4 Ghana cedis as I'm talking to you. But if you wanted a get-rich-quick way of making money from the stock market and you bought a weak company that disappeared from the markets within some short period of time, you would have lost everything. That is why diversification is very, very important. Don't put all your money in one stock. Always spread out your investments. Put some in telecommunication, banking, some in consumer goods, even some in global stocks, which I've been doing all the time. Most of my money is being put into global stocks, which I make more money because when the dollar goes up, I make more additional money on what I have in dollars. And the last point I will talk about is being patient, right? You always have to be patient when you are investing. Investing is like planting a mango tree, right? You don't plant today and expect to get the fruits tomorrow. Give it some time and it will grow to be fruitful for you to enjoy. So these are the 5 most important things that you need to consider buying in stock, whether being in the Ghanaian stock market or the US stock market. First, you have to understand the business, check the financial health, look at the price or valuation, pay attention to dividends, and also think about long-term and also manage your risk. If you can master these basics, it means you will be able to avoid many basic mistakes that a lot of people do and set yourself for success. Let me know in the comment section below what you think. Which company are you currently holding or considering? And do you think it takes all the 5 of these boxes that I have mentioned? Diversification is key, so put it in your head. Thanks for watching, and if you found this video helpful, don't forget to like this video, share and subscribe for more investing tips. See you in the next one.